Hi, my name is Leland Yates. This is my investment strategy for Finance 452. The title of my project is To Dividend or Not to Dividend. Essentially what my strategy is since stocks that do not pay a dividend are typically considered high growth stocks, i.e. such as your Google and things like that, you're typically expecting that you're going to pay for growth. Basically dividends, what a dividend is essentially is at the end when you retain earnings, when everything is left over, your dividends are what either you pay your dividends back to your shareholders in a dollar amount. If you don't pay dividends, it's typically assumed that you're either A, wasting the cash, or B, you're reinvesting into projects and growing your business. Since we don't want to think that, we're going to assume that all these stocks that I've invested in now are reinvesting all their dividend portfolios. All their prices for their dividends are going back into the business. So what I did is I picked 6 blue chip stocks that pay dividends, and I picked 6 blue chip stocks that do not pay dividends. Basically, I measured their returns for 1 year against the S&P 500, and I wanted to see if it was statistically different whether or not a stock paid dividends or did not pay dividends that match the returns in the market. The companies that we have, my non-dividend paying companies are Amazon, Chipotle, eBay, Netflix, and O'Reilly's. All these are very high growth companies. They've got very large stock prices, and they've never paid a dividend, ever, not one penny. The next one we have over here, we have our dividend-paying companies, which is Wells Fargo Corporation, John Deere, IBM, Procter & Gamble, and General Motors, all of which are known, especially GM, to pay handsome dividends every single quarter. Essentially, this is what we have for my portfolio where I did the returns for no dividends. As you can see, the average return for your no dividend portfolio is a 1.5% overall portfolio return for the entire year. For our portfolio that did pay dividends, our average return was 0.02%, so not even an entire percent. The benchmark for the S&P is right here. I did a t-test essentially to see how everything goes. My conclusion that I did was in running my t-test and my regression was that, oddly enough, according to the statistics, is the p-value for the companies that paid dividends was 0.01, which is less than your 0.05 that you need. So there is a statistical difference. There is a statistical significance between the returns on stocks that pay dividends and the returns in the S&P 500. So they do move very similar. There's a big similarity there. In the ones that do not pay dividends, you've got 0.78, which is higher than your 0.05, which can essentially mean that the S&P 500 and the stocks that pay dividends are not remotely correlated whatsoever. I didn't necessarily consider this a loss because even whenever you go back and you look at your portfolios, my hypothesis might have been incorrect because I assumed that stocks that did not pay dividends were going to move better with the S&P 500. That was not the case. However, it's not really that much of a loss. This test was done solely on stock price returns, so I did not include the little kickbacks you get from the dividends each month in my annual returns. I did not include that. And then also, the fact is my first portfolio with no dividends had a 1.5% average return, which is 100 times % more than the average return of the no dividend portfolio. So honestly, I really kind of think it really all boils down to your risk preference. Your higher dividend, your stocks that don't pay dividends, they're going to grow a lot faster. Your Googles, your Netflixes, your Amazons, they've got really high stock prices. But you're not necessarily going to be guaranteed as much as a sporadic return with the market. Whereas your dividend paying stocks, such as your John Deere or anybody or Microsoft, they may not have as high a growth or high of returns, but what you are going to have is you are going to have a steady move with the S&P 500 in the market. So I guess it really just all depends on how you would like to hedge your risk. And that's my project.